Hey there, Livewire viewers. It's James Marley here, and welcome to this episode of Views from the Top. My guest today is Bob Desmond, Portfolio Manager of the Claremont Global Fund. Bob, great to see you, and thanks for coming in.
Good to see you.
Let's get into it. The past year, we had a big change in the operating environment. We saw that big ratchet up in interest rates. What impact are you seeing that have on the companies in your portfolio and on your watch list?
It hasn't had a major impact, to be honest, James. I mean, our companies, we're almost net cash across the whole portfolio. So one of the key things in our philosophy is not to own weak balance sheets. So on the debt side, it's not making a huge difference. We always use through the cycle inputs on our valuations. So we use, long-term averages in terms of determining what sort of discount rates or multiples we're putting on businesses. So that's through the cycle inputs. So we don't use year to year. In some instances, actually, in some of the recent numbers, I've actually been upgrading my numbers because some of the companies we have a lot of cash, which for a long time has been earning nothing, and it's quite noticeable. You can actually suddenly see the uplift in their interest line. But at a company level, it hasn't had a major impact yet, not on the business model nor on the valuation.
Yeah. What about the operating environment? You talked about inputs there, mostly financial metrics, valuation metrics. What about the flow-on effects of higher interest rates on the consumer, or how these companies are finding the operating environment? We've seen layoffs, particularly in the tech industry, more redundancies, those sorts of things.
The layoffs in the tech industry might surprise you. Actually, for us, we think it's been a net positive because I think there was such a distortion of capital and a lot of labour sort of going into Silicon Valley and hoping to IPO their stock and sitting in the corner and earning $250,000, not really doing very much. So for a lot of our companies, what we found is through COVID, the revenue growth was very strong, especially the tech companies, obviously, but there was margin slippage because comp was a big issue. And it wasn't just the tech companies, we saw it in some of our other ones. We've had the exact opposite kind of happen in the last time, where basically suddenly there's more workers in the marketplace. You can look at some of the IT services companies, their long-term attrition has come down a lot. So for us, actually, those sort of layoffs have been a positive. In terms of the companies, what they're saying, and obviously we're about to go through an earnings season, I mean, slight moderation, I would say, in demand, but nothing major. I mean, where you really have seen it is probably more in the subprime, sort of consumers have been struggling with inflation and the cost of living types of things, but no major real impacts yet. And it has been surprising to me, to be honest. I would have thought that magnitude of move in rates would have had a bigger impact. Maybe that's still to come.
Yeah. The higher rates backdrop was positioned as a headwind or a negative for investors. Do you think overall it's a better environment now with these more normalised levels of rates?
I couldn't agree more. I think you've got to have a financial system that has a proper cost of capital. So we lived for a long period of time. I mean, it seems weird now when you talk about TINA, there is no alternative. Yeah. Now at least, investors have a proper cost of capital, long bonds sitting somewhere around 4%. And I think that's good because it stops, like I was talking about earlier, that distortion of capital. We know we had a ridiculous bubble in Silicon Valley and IPOs and fintechs and Bitcoin, and it just got really silly with that wrong cost of capital. So I think as a business owner, which we are, I think it's much better having a proper cost of capital. So I'm in favour.
Okay. So you're a Claremont focused on global equities, and you definitely have a preference for value. From my understanding, 2023 was a really strong year for global equities. If you look at the NASDAQ, it was up 55%, which is staggering. The S&P 500 up 25%. How have these rallies and these runs, particularly in these US markets, impacted your ability to find value?
The gap between what we think our companies are worth and where share prices are, that gap has closed over the last 12 months. Back end of 2022, the fund was as good value as we've seen it in a number of years. You could look at anything like, our estimated discount to value was more than 30%. Our PE multiple at the peak was probably 30 times. It had fallen back to 22 times. So, we went into 2023 with a very nice cushion of value. I think last year the fund was up 24%. So obviously our valuations weren't up 24%. So that gap has closed. So we've kind of closed now to pretty much in line with our long run averages of where our companies normally trade, both in relation to their discount to value and also their multiples.
Talk in a little more detail around where you are seeing value from specific sectors, but I wanted to have a chat around something that's unique about the way you invest, which is 10 to 15 stocks in the portfolio, which is quite concentrated. Could you tell me a little bit about how you determine how much you allocate to a particular position? My reading tells me you can do 10% maximum.
Yep, you can.
You know, that's, as I said, quite concentrated big bets. How do you determine how much gets allocated to a particular stock?
It is pretty much determined by the discount to value. Yeah. So the businesses that we own that are trading at the biggest discounts to value will get the most capital, and that would be, let's say, a 9% weight. And the ones that are trading close to fair value would probably be a 2 or 3% weight. And then we just allocate across the spectrum. So, biggest discount gets the most weight.
Yep. And how frequently does that get updated?
Well, we obviously update the share prices every day. So we look at the share prices every day. In terms of trading, we can often go months without trading. Yep. And then there will be periods where we can be very active if markets are very volatile. Yep. But to give you an idea, last year, I think it was 1 stock in, 1 stock out. The year before, it was 4 stocks in. So we certainly aren't traders. We are holders of businesses through cycles.
Something that doesn't get discussed that often in the interviews we run is sort of lessons from the buying and the selling process. We often focus on what stock looks cheap or whatever it might be. What have you learned over the years about creating value or generating additional returns from being a good seller, being a good buyer?
Buying's easy. Buying is probably the easiest thing to do because you've spent a lot of time researching a company. Everyone wants to buy. There's an element of confirmation bias. Yeah. So if you think about it, you just say you spent the last 6 months just researching one business, you're naturally going to have an inclination to want to buy. And generally, most of the academic literature, people buy quite well. Okay. Selling, I think, is the toughest discipline in funds management. So there's 2 things in the way we run money. It's just our way. One is selling when something's done really well. That's difficult to do because no one wants to sell winners. So making sure that you stay with your value discipline and that a quality growth portfolio doesn't kind of morph off into a momentum portfolio. That's one. But the other one that's also really hard to do is to sell a loser. Because once you sell a loser, you have to admit that you've made a mistake. Before you've sold, you can hope it gets back or whatever. So we have a rule that if a stock position has gone against us and we're not prepared to add to that position, we will cut it.
And are you, your selling process, are you exiting positions in their entirety? Are you, a stock's gone well, it's been a winner, you're right. Do you take some money off the table? Do you take half profits? How do you think about that? Is it a black and white, it's in, it's out, or do you?
No, we manage to value. So in a natural way, a natural progression would be, let's say we put a business in, it's trading at 30% discount to value. That might be an 8 or 9% weight. As that sort of value gap closes, we'll be trimming. So by the time it gets to fair value, it'll probably only be 2 or 3%. Then we recycle that capital either into existing businesses or into a new position, but making sure that the uplift we get on value is meaningful, at least 20%, because we don't want to be trading every day for a couple of percent. So that's how we kind of manage it.
Okay. Well, let's move from the theory to the practice. Love to hear about some of the opportunities that you're seeing out there in global markets at the moment. What's looking interesting to you?
Interestingly, with the macro being quite negative, so some of our consumer discretionary names have definitely been, we're seeing value in that sector.
Because they're unloved? Is that it?
Yeah, I think everyone's worried about a consumer slowdown. We recently added to the position one name in consumer discretionary. Yep. Still building that position out. One of our biggest weights is consumer discretionary. I think it's just we just allocate in terms of where's the value relative to everything else, and certainly consumer discretionary is where we're seeing value.
And what's been the funding source for that?
We've been trimming in tech, so large cap tech, obviously last year, no surprises, did very, very well. So we've definitely trimmed some of those positions. We took quite a bit out of Adobe, which was a huge winner for us last year.
Yep.
So we have been trimming tech, I'd say would probably be the main funding source, which is not a surprise seeing what it did last year.
Could I get you to take me a bit more inside the thesis that's supporting your consumer discretionary allocation?
Sure. I'm actually happy to mention the names of the companies. So one of our biggest positions is Nike. So that's not based on a view on consumer discretionary. At the end of the day, why we own Nike is we think it's got enormous competitive advantages. It's got a great brand. It's got very, very strong innovation. It's got great distribution, And the key thing within Nike is increasingly they're direct to consumer. So taking out third-party distribution, especially the long tail of weak third-party distribution.
Yeah.
Once you actually do that, you can control pricing, you can control display, you can get a whole heap of data, and obviously you get the full margin when you sell it because you don't have to give away a whole margin to the wholesaler. So we can see Nike's margins going up over time. So what's more interesting to us is, if I look at most commentators, they'll go, oh, what's the macro going to do? Therefore, work out the macro, and that'll determine, let's say, our stock pick for the next 12 to 18 months.
Yeah.
The way we think about it is, what are the competitive advantages in this business, and what do we think the earnings are going to be 3 to 5 years? And we think Nike's earnings in 3 to 5 years will be much higher than they are now. The other consumer discretionary name we've added, which we've owned before, is Louis Vuitton, or LVMH.
Yeah.
Again, people are worried about a slowdown in luxury goods spending. They're worried about China. So that stock's been under pressure. That's normally our entry point.
Yeah.
Yeah, and we've added to that.
Nike, an interesting one. I note that they've just parted ways with Tiger Woods, who's been an ambassador for them for nearly 3 decades. Is that material for a company like Nike?
Over the long term, I would say no, because there's always going to be sportsmen who are moving on and new ones, the next Tiger, new ones coming through.
Yeah.
I mean, I think at the end of the day, they're able to spend vastly more than their competitors on marketing, what they call it, demand creation.
Yeah.
And that's the key really for them. So Tiger moves on, but they'll be the next Tiger or the next one coming along.
Staying with just Nike a little more, you talked about the growth and that ability to control the supply, the chain all the way through to the distribution. Is that about Nike opening more stores and having a store roll-out plan? Is that 3-year growth picture that you see?
I mean, the bigger part of it actually is not the physical store, it's actually the movement from store to online.
Yeah.
So going online and people either buying it on a website or through the Nike apps. So that's actually been more of a move than Nike just rolling out and opening a huge amount of stores. It's really taking the tail of third-party distribution, which is quite weak. Yeah. If you go to some average retailer, terrible layout, there's probably some sort of uni student who's working there, just wants to kind of just sell as much as he can, he's discounting, the display is terrible. That's just terrible for the brand. Mm-hmm. So taking out that weak sort of third-party distribution and then controlling the distribution, price, display, data, pricing.
Well, Bob, before we wrap things up, the show here is called Views from the Top. I was hoping you could share a view from the top, a lesson, a perspective that you have that you wouldn't have developed if you hadn't been running money for as long as you have. So what's your view from your top as we sit here today?
The most important thing for us, and obviously everyone has their own way of doing things, but for me, it's thinking long term. Yeah. So making sure you think long term, and if you are thinking long term, the natural addition to that is buy quality. Rather than trading stocks and markets, buy businesses for the long term. Think like a business owner rather than a trader. And there's lots of people who can trade, to be fair, and that's their game. But our game is think long term, buy quality for the long term. Buy businesses that you understand is really, really important. Don't buy stuff you don't understand. Just like a business owner, you stick to your business. You're not going to go off and do anything apart from media. Stick to your core business. And then also, most importantly, don't get sucked into hype and stories. There's always promoters out there who are going to sell you the latest theme, the latest story. More often when there's something like that, I just run a mile because I just think it's people just trying to sell product rather than actually get clients decent returns. And then buy at the right price. So generally that means buying when everyone's feeling negative. That's the only way you're going to get a bargain. My favorite is when the whole market's really depressed and everyone's negative about the whole market, but you can actually pick up really good businesses at the right price.
Well, thanks very much for coming in today.
Thanks, James.
To all you viewers out there, I hope you enjoyed that episode of Views from the Top. Remember, hit subscribe on our YouTube channel. We're adding fresh content just like this every week.